This presentation is brought to you by Andria, Trish, John, and Terrence.
U.S. GAAP, or Generally Accepted Accounting Principles, was created by the Financial Accounting Standards Board. GAAP is the set of guidelines that accountants in the United States must follow. GAAP was created to protect companies, investors, and other stakeholders from questionable accounting practices made by businesses. Without GAAP, companies would be free to decide for themselves what financial information to report and how to report it. The American Institute of Certified Public Accountants is a group of CPAs who originally set out the guidelines by which all accountants must practice. The authoritative committee that was originally responsible for defining accounting principles for the AICPA was the Committee on Accounting Procedure. In 1973, the AICPA and Accounting Principles Board had to transfer this responsibility to the Financial Accounting Standards Board, a nonprofit company that was appointed by the Securities and Exchange Commission.
The International Financial Reporting Standards, or IFRS, are the global principles to guide public companies in financial statement preparation. In 1973, the International Accounting Standards Committee was given the task of overseeing and implementing international accounting standards. The committee included representatives from Europe, Australia, and North America. The first international accounting standards were distributed for the global public in 1975. By 1999, over 100 countries had adopted IFRS and were using the 41 issued standards and 32 interpretations. The International Accounting Standards Board was formed in 2001 to overtake the current committee. The Norwalk Agreement in 2002 promised the future convergence of GAAP and IFRS into one globally accepted set of high-quality accounting standards. By 2005, the European Union required all public companies in Europe to adopt IFRS, and 2 years later, the SEC gave U.S. companies the option to convert. The Securities and Exchange Commission released 7 milestones in its plan to require companies to use IFRS. The first step is improvements in current accounting standards. Second, there needs to be accountability and funding of the International Accounting Standards Committee. Third, improvements need to be made in the ability to use interactive data with IFRS reporting. Next, companies and individuals need to be educated on the International Financial Reporting Standards. Step 5 is the early use of IFRS in the U.S., and Step 6 is where the U.S. currently is, waiting for the future ruling of the SEC to lead to the final stage. The last step is implementing the mandatory IFRS use of public companies in the U.S. These steps show the phased-in approach that the SEC hopes to potentially complete sometime in the near future. The IASB functions under the supervision of the IFRS Foundation. The board is an independent private sector group made up of 16 members who develop and approve new standards. IASB is responsible for developing new technology with appropriate input from the IFRS Foundation trustees and the general public. It also prepares and issues new reporting standards in accordance with the process from the IFRS Foundation Constitution. The IASB controls the approval process and issuing of all international financial reporting standard interpretations. U.S. companies can receive a lot of benefits by converting to IFRS. Comparing financial information with foreign competitors is simplified when both parties use IFRS. When a U.S. company has subsidiaries in various countries that allow IFRS, daily operations become easier with the same company-wide accounting principles. Using IFRS makes a U.S. company more appealing to foreign investors so it can raise additional capital from abroad. Some people believe a disadvantage of IFRS is a decrease in the quality of accounting practices. They feel that U.S. GAAP is of superior, high standings and do not want to convert to IFRS. When a company lacks a presence outside of the U.S., it often sees no need to change its standards because of the significant costs of changing to IFRS financial statement preparations.
As the convergence of IFRS continues by the ISAB and FASB, the differences between IFRS and US GAAP are becoming smaller each day. However, there are still significant differences. For example, IFRS does not permit the inventory method LIFO, last in, first out. In addition, in relation to impairments, IFRS uses a single-step method to write down assets, while US GAAP uses a two-step method. As a final method, IFRS requires capitalization of development costs once certain qualifying criteria are met, while US GAAP generally requires development costs to be expensed as incurred, except for costs related to the development of computer software, for which capitalization is required once certain criteria are met. Whether or not countries are for or against IFRS, the process is already underway for the world to convert over to IFRS. Any country that operates in foreign countries is directly affected by the IFRS convergence. A statistic released by the IFRS Foundation states that, since 2001, almost 120 countries have required or permitted the use of IFRS. This figure is only expected to rise as IFRS comes closer to completion. As stated above, most countries are converting over to IFRS because they see the benefits, which include easier participation in international trade and work with companies that have other forms of GAAP. With many countries committed to converting to IFRS, the next step is determining when IFRS convergence will officially be adopted. Unfortunately, it is currently unclear when the members involved in the IFRS convergence will finish the process. In addition, according to one source, it will take time for investors to become confident about rating IFRS accounts, although that happened quickly within the European Union. Regardless of the time frame, it is likely that US GAAP will never be eliminated entirely as an accounting option. Overall, although IFRS would unify the accounting reporting worldwide, there are still some countries that are skeptical of the idea. For example, according to an article written by Walton from QFinance.com, evidently having different national accounting systems is costly for companies and investors. Companies have to keep duplicate accounting systems, and investors are wary about buying shares of companies whose accounts they do not understand. In addition to the added cost, the conversion to IFRS also worries investors who are used to seeing information presented in a specific manner. Unfortunately, the real loss occurs when potential investors are not considered because a company chooses to not adopt IFRS. Without a direct comparison, investors will never have the opportunity to view and consider another company for investment.
The differences in financial statement presentation between IFRS and US GAAP are numerous, but many of the discrepancies do not drastically change the bottom lines of the individual statements. For example, under IFRS, assets and liabilities are not listed in order of liquidity. Listed are some more dissimilarities between IFRS and US GAAP, most notably the order in which line items are presented. For example, IFRS does not prescribe a format outlining the construction of the income statement requiring only certain items. Conversely, under US GAAP, the balance sheet is very precisely laid out. However, management has multiple formats in which they may follow. The Companies Act was passed by the Parliament of India to govern corporate affairs in 1956. This code was revised and replaced by the Companies Act of 2013. All corporations in India must adhere to this act along with legislation pertaining directly to their industry. An example would be Indian banks not only must follow the Companies Act, but must also comply with the Banking Regulation Act of 1949. Indian GAAP differs from IFRS and US GAAP in a multitude of ways. These are some examples as to how. Balance sheet format is not laid out in detail. Certain line items must be present, similarly to IFRS. Two unique aspects of Indian GAAP is that plant, property, and equipment may be revalued annually and fairly easily. Additionally, a statement of recognized income and expenses is not required at all under Indian GAAP. Additionally, revenue recognition in the cash flow statements under Indian GAAP closely resembles those policies under IFRS. There are many other discrepancies between these three ideologies, but these are some of the main points.
Thank you for your time, and we hope you enjoyed the show.